Top 10 Biggest Financial Crises of the 21st Century. The 21st century has witnessed several major financial crises that shook economies, businesses, and individuals across the world. These crises were caused by a combination of factors, including reckless financial practices, economic downturns, and unforeseen global events. Here are the top 10 biggest financial crises of the 21st century and their impact. The Turkish Financial Crisis, 2001. The Turkish financial crisis of 2001 was triggered by deep-rooted structural problems in the economy, including an over-reliance on short-term foreign loans and a fragile banking sector. Political instability and failed economic reforms led to a major confidence crisis, causing a severe devaluation of the Turkish lira. Inflation soared, interest rates spiked, and many businesses collapsed. The crisis eventually forced Turkey to adopt strict economic reforms under the guidance of the International Monetary Fund, IMF. 9. The Argentine Economic Crisis, 2001 to 2002. Argentina's economy collapsed in 2001 after years of mismanagement, high debt levels, and a failed currency peg to the US dollar. The crisis led to widespread protests, a series of rapid presidential resignations, and a default on the country's $132 billion debt, the largest sovereign default in history at the time. The banking system collapsed, unemployment skyrocketed, and millions of Argentinians fell into poverty. The crisis highlighted the dangers of unsustainable economic policies and foreign debt dependency. 8. The dot-com bubble burst, 2000 to 2002. The late 1990s saw a rapid rise in internet-based companies, many of which had little to no profitability. Investors poured billions into dot-com stocks, creating a massive speculative bubble. However, by 2000, the bubble burst as many of these companies failed to generate real revenue. Stock markets crashed, wiping out trillions of dollars in value. The Nasdaq Composite lost nearly 80% of its value from its peak, leading to the collapse of numerous tech startups. It was a painful lesson about overvalued assets and speculative investment. 7. The European Debt Crisis, 2009 to 2014. After the 2008 global financial crisis, several European countries, most notably Greece, Portugal, Ireland, Spain, and Italy, faced overwhelming national debts and economic stagnation. Greece, in particular, was on the brink of bankruptcy, requiring multiple bailout packages from the European Union and the IMF. Austerity measures were imposed, leading to mass protests and political turmoil. The crisis exposed deep flaws in the Eurozone's financial system and raised questions about the future of the European Union's economic structure. 6. The Chinese stock market crash, 2015 to 2016. China's stock market experienced an unprecedented boom in 2014, driven by speculative investments and easy credit. However, in mid-2015, panic selling led to a market crash, wiping out trillions of dollars in market value. The government intervened with drastic measures, including trading halts and liquidity injections, but confidence in the market was severely damaged. The crash had a ripple effect on global markets and raised concerns about the stability of China's economic model. 5. The COVID-19 pandemic recession, 2020 to 2021. The COVID-19 pandemic triggered one of the worst global recessions in history. Lockdowns, travel restrictions, and business closures led to massive unemployment, economic contractions, and market crashes worldwide. Governments responded with unprecedented stimulus packages, and central banks cut interest rates to historic lows. Although markets recovered relatively quickly, the pandemic exposed vulnerabilities in global supply chains and economies, leading to long-term economic challenges. The Russian financial crisis, 2014 to 2015, Russia faced a severe financial crisis in 2014 due to a combination of Western economic sanctions following the annexation of Crimea and a sharp drop in global oil prices. The Russian ruble lost over half of its value against the US dollar, inflation soared, and economic growth collapsed. The crisis forced the Russian government to implement capital controls and raise interest rates dramatically to stabilize the economy. The crisis demonstrated how geopolitical tensions can have significant economic consequences. 3. The global financial crisis, 2008 to 2009. The 2008 financial crisis was the worst economic downturn since the Great Depression. It was caused by excessive risk-taking in the housing and financial sectors, particularly the use of subprime mortgages and complex financial derivatives. When the housing bubble burst, major financial institutions collapsed, including Lehman Brothers, causing panic across global markets. Governments had to bail out banks and introduce massive stimulus measures to prevent a complete economic collapse. The crisis led to widespread unemployment, home foreclosures, and a loss of trust in the financial system. The Sri Lankan economic crisis, 2021 to 2022. Sri Lanka faced an unprecedented economic crisis in 2021 to 2022 due to poor economic management, a loss of tourism revenue during the COVID-19 pandemic, and excessive foreign debt. The country suffered from severe fuel, food, and medicine shortages, leading to mass protests and a political crisis. The government eventually defaulted on its debt, and international financial aid was required to stabilize the situation. The crisis highlighted the dangers of unsustainable borrowing and weak economic planning. 1. The inflation crisis, 2021 to present. The world is currently experiencing one of the most severe inflation crises in decades. A combination of pandemic-related supply chain disruptions, massive government spending, and the war in Ukraine have led to skyrocketing prices for essential goods and services. Central banks worldwide have raised interest rates to combat inflation, but the economic impact remains uncertain. Many experts fear that prolonged high inflation could trigger another global recession, making this one of the most pressing financial crises of the 21st century. Conclusion: financial crises have shaped the global economy in profound ways, leading to massive job losses, social unrest, and policy changes. While some of these crises were caused by poor economic decisions, others were triggered by external shocks like pandemics and geopolitical events.